Hey there, welcome back to CyMo School. Today we're diving into the wild trading action of June 12, 2024, which was FOMC announcement day. The Federal Reserve was set to make their rate decision at 2 p.m., and we'll be focusing on how the CyMo Pro performed throughout the announcement and Jerome Powell's speech. We'll also emphasize avoiding whipsaw trades when taking your entries. So, let's get started. At 2 p.m., when Jerome Powell made the announcement, we saw the cycle, cyan line, coming down, while momentum was flat. It almost seemed like the price was going to drop further at the 215 mark. Cycle hit the zero line, but didn't cross, while momentum was already moving down. The fact that the cycle didn't cross below the zero line was crucial because if it had, it would have meant a continuation of the downside trade. Instead, it stopped right at the zero line. Now let's see what happened at 2:15 p.m. Using a 4-minute chart can illustrate the rotation of the cycle in more detail, helping you see where the cycle movement is relative to the signal on the 15-minute time frame. At around 2:14, the cycle on the 4-minute chart had bottomed out and was about to go up. This was the first clue that the setup on the 15-minute chart wasn't going to go short. What happened next? In the subsequent bars on the 4-minute chart, the price ticked up and continued rising until 2:34 p.m. On the 15-minute chart, the cyan line never crossed below the zero line. By 2:30 p.m., both cycle and momentum did an about-face and turned up. Let's see if 2:30 p.m. was a viable entry to go long on the 4-minute time frame. At 2:30, the cycle was just completing its rotation at the upper threshold of 0.80. This wasn't a setup to go long just yet. Remember, there are nearly 4-minute bars in a 15-minute candle, meaning there's a lot of rotation within the 4-minute before the price takes off in the desired direction. If you get a signal to go long on the 15-minute chart and the cyclic component is at the upper threshold, it indicates that the price is likely to go down before it goes up. So even though there was a setup to go long at 2:30 p.m. on the 15-minute chart, always reference the 4-minute chart to see where the rotation in price is occurring. In this case, the rotation was above the threshold, so it wasn't yet time to pull the trigger to go long. Cycle then fell to the bottom threshold. When it crossed above the momentum line, that was your entry to go long at around 2:58 p.m. You already had confirmation from the 15-minute time frame that the price was going to move up. Your entry point was when the cyan line crossed above the momentum line. From there, the trade setup would have begun at 2:58 p.m. and continued until the cycle crossed below the momentum line at around 3:14 p.m. Momentum continued to rise, and the end of the momentum swing would have been when momentum collapsed at 3:26 p.m., marking the exit of that trade to the upside. When the price was going up, the cycle crossed below the momentum line at 3:30 p.m. on the 15-minute chart. If you noticed that cycle crossed below the momentum line at 3:30 p.m. and saw that momentum was already falling on the 4-minute time frame, this would have been your cue to go short. Your short trade would have ended when the cycle crossed over momentum at approximately 3:34 p.m. The key takeaway from this tutorial is to always reference a lower time frame chart to monitor your entry points and the cyclic rotation in price. The 4-minute chart does a great job of monitoring this rotation. If you get a long signal on the 15-minute chart and see that the cycle is way above the threshold, chances are the cycle will do an about-face before it runs up in your desired direction. This approach helps you better time your entries and avoid the interbar whipsaw that often happens on the 15-minute time frame if you take a late trade. Hope this helps. Thanks for watching this episode of CyMo School. Now get out there and crush those trades.